It's May 23rd, and it's been a good day in the market. I was listening to the news today, and it said that they mentioned my two biggest positions, Apple and Goldman Sachs, in the news as some of the biggest gainers contributing to today's rally. So that's encouraging when both of my biggest positions are in the news for doing well. So I'm going to take you through the account of basically and just talk about the positions and my plans for what they are a little bit in the future. Also update you on my leverage situation and what's happening with the accounts. So I'm sitting at 165, 500 at the moment, up almost 7.5 grand today. The swings are pretty wild. I mean, 4.7% today on the upside. It's still bright because the market after hours hasn't closed yet. So Robinhood keeps this white. Well, I think I can actually choose whether to have it white or black, but this is cool. So here are the options positions on the right. I'm gonna scroll through them fairly quickly. I've actually placed new options today, since it's Monday, and I was able to hit them in the morning. Granted, I would have been able to get a better deal for my options about midday, but I set them last night and I actually hit them. It's one of the very few times I've done that. So, but it worked out okay. I'm not too mad about it. Probably collecting about $1,000 in premium from these newly placed options. So I'm gonna scroll through them really quickly. You can see them at the top, the newest ones, and then you can pause the video player at any moment to try to find out the exact information on the position. Everything is listed right here that you might need. The numbers on the right are the days change in value on dollar amount on top and the percentage on the bottom. Here are the equity positions. Apple, I've sold three call options against it, so I'm not gonna have 880 shares. I'm gonna have 580 by the end of the week, hopefully, if Apple rises enough to make sure you hit all those strike prices on the options. But you can see it went up 3.74% today, which is pretty massive. JD.com had a good day, despite the fact that it released a dividend. So if you're interested about that, JD actually released their cash dividend. Here you can see it's pending. So it looks like June 14th is gonna come, which is not too soon, but it's $310, which is more than I expected. So I was holding only 250 shares as opposed to the 550 that I used to have. Could have had a 600 and something dividend instead. But anyways, I digress. It's $1.24 per ADR. It's way more than I thought it was gonna be like 60 cents or something per ADR. But moving on, so that's JD, and then VIP shops was about flat, I guess. Realty income down a percent. Main Street Capital up a percent. Main Street Capital is now a larger holding because I sold some puts against it at the $38 level, and now it's 36. So they end up executing, and now I have 660 shares of Main Street Capital, which is really large, which turns out to be a little bit under $24,000, which is, I think, higher than my realty income position right now. Yep, it's higher. Realty income is sitting at 21,600 at 321 shares. Both of those are set to reinvest. So whenever the dividend comes in each month, it just gets reinvested straight into the same holding to give me a higher dividend next month. And both of these companies actually like to increase their dividends. I think Realty Income likes to increase it quarterly, Main Street Capital probably yearly, or maybe more often. I haven't looked. I don't know for sure. I mean, I have looked, but not recently. So both these like to increase the dividends, and with the reinvestment, dividends gets bigger, and those two positions comprise the larger, the one of the bigger positions of my main holdings in the account. Like I want those to keep growing exponentially and to not, ever be sold. I don't want to sell call options against it. Although I might sell call option against the main position because it's just taking up such a large portion of the account. So yeah, we'll see about that. Goldman Sachs up 3.57%. So Goldman Sachs and Apple are killing it today. I did sell calls against Goldman here at 325, which is where I've been trying to exit the position. Currently, it's 317.75, so hopefully another few good days ahead, and I can get rid of those 200 shares of Goldman Sachs, deleverage a little bit, and be left with about 35. I might actually even sell 5 or 10 more, depending on what the price does. I have been kind of, not day trading, but kind of like swing trading Goldman Sachs a little bit. I'll show you the activity. So I've been getting like $50 per trade or something small like that, but you can see I have two sells here for 1,597, 570, and then another one at 525, and there's a buy here at 498, another sell 565, another sell 532, and then here's the buy at 489. So I've been buying it around 500, 1,500 for every 5 shares, and I've been selling it for the higher 500s basically. So that's what I've been doing with Goldman. Oh, it looks like something dropped just now, the aftermarket. It's probably Apple. Yeah, it looks like Apple dropped 0.45. So that's the account here. Let me go to the investing tab. You can see the margin is a little bit less than yesterday. Yesterday was 48.88. Now it's 46.88. So that's good. Reducing margin, reducing risk. Here are the positions, if you're interested, by total return. Apple is the biggest returner. Obviously, the longer the position I hold, the larger the gain for majority of the cases. Here it is by equity. Apple the largest, Goldman Sachs second largest, and then Main Street Capital is now third. I do have a significant amount of money into Alibaba call options though, so got to take that into account. So I've been listening a lot to the financial media, and a lot of people seem to be pretty bearish still because, if you think of the Federal Reserve as the operating the market, there's this thing called, the Fed put. People are arguing that the Fed put is got a lower strike price, and now they've introduced the Fed call as well. So what that means basically is that the Federal Reserve is going to make sure that on any rally, it's going to knock it down. In the markets, it's going to knock down that rally, and then it's going to let the market drop a lot further than it otherwise would before it steps in and does something to rescue it. So that's what that means in options terms. And I would probably tend to agree with that sentiment, but the thing is, like, all these other dynamics that I've talked about in the past are still in play. There's just such huge money flows each month into the markets, especially in the American stock markets. Everybody's 401ks, everybody's retirement funds is invested into the markets. Maybe the percentages have shifted now. People are perhaps more conservative with the approach, but there's still a ton of money going into the markets every month, right? Sometimes every 2 weeks, and this money flow is really hard to fight. I understand that you can reprice something with just a few days. If no buyers show up on a couple of days, just a few large players can reprice everything. That's true, but then for how long is that gonna last? Can you really fight that fund? And plus, on top of that, let's say you sell everything. What are you gonna do with that money? You're just gonna sit in cash, right, or cash deposits, collecting interest, and then eventually, you're gonna have to bring that money back into the market. You just don't know at what point, right? So all these large players that are sitting on a ton of cash are gonna have to bring that money back in. And so here we go, right? We have the cash flow of the 401kers and the retirement funds. And then after a specific amount of time, I don't know how long it's going to last, maybe 6 months or a year or whatever, the money eventually has to come back in from the big players. And so I am still pretty bullish long term, and I don't want to get caught, right, with my pants down, like sitting on a ton of cash when the market's about to explode. So that's just my sentiment here. That's what I see, and I appreciate all these commentary, and I agree with it temporarily. But all the forces that have been in play are still in play, and I'm just gonna remain bullish, at least nominally, right? Because that's a big difference on the markets. Not necessarily real returns, since we're seeing like 10% inflation, right? So if you get 9% on the markets, you're still losing 1% of purchasing power per year. But I do remain bullish, and I think that we're going to close in positive territory. I don't know about this year, but for sure next year, well, high probability next year and the years ahead, especially if inflation's still up. It actually has, a positive nominal effect on the market. So you can look for that. All right, I'm going to end this episode right here. If you have any comments on the markets, please let me know below. Peace out.